January of 2025 was a solid U.S. share returns month. In fact, the last 2 years delivered exceptional annual returns years for the U.S. share indices. Our chief equity strategist and economist, John Blank, is here now to help us understand what's driving this. John, what is the main driver for the solid stock market returns?
Well, Terry, I'm looking at data from February 26, which is yesterday, and we've got 90% of the S&P 500 in, which is 456 of 500 companies. And earnings year on year are up 13.6%. So I'll repeat that, 13.6% on 5.5% higher revenues, which is a really strong quarter. And if you look at it from a historic perspective, this is as strong as we've had since the fourth quarter of 2021. So that's almost 4 years ago. So seeing a 13.6% year-on-year quarter for the fourth quarter of last year is an unambiguously strong and signal that we may not, but we can get double-digit earnings growth this year, and that is supporting the stock market.
So as I watch the market day to day, after two fast-paced years, the market seems like it's taking it a little bit easier so far this year. Is it, or am I imagining that?
No, we've gone sideways since the election on most of the major indices. We did have a bounce in January. We gave it all back in February. And basically, it's the uncertainty of the new administration that is causing a lot of hedging on the part of consumers and investors and business executives, trying to figure out what to do in the face of a constant chaotic news cycle of tariffing, job cuts at the federal level, some layoffs in the private sector, and just generally a sense of not having as firm a footing on the actual path of 2025. So while the earnings growth of fourth quarter was really the solid indicator, the last 2 months, particularly, since the inaugural, we've had something else that's much more concerning.
So that said, what risks has the stock market priced in right now?
Well, I don't know that the stock market's priced in much, Terry, because, if you look at the forward 12-month price earnings ratio, is 22.2, and the 5-year average is 19.8. So that is 2.4 ticks above a 22, which is well over 10% of the 5-year average. So the market is still very bullish in the valuation context, and it's either, getting it right, or we're going to see a correction of 10% and getting it wrong, Terry. And I think that's why we're stalling out here. The market hasn't decided which one of those scenarios is the one we're going to see.
Are there any risks that you see that the market hasn't priced in yet?
I do worry that we're going to see more chaos in terms of job cutting in a pattern of circularity to the job cutting that cascades into worse performance for the economy in the next 3-4 months. And I just don't see how we get away from news cycle obsessed administration and constant need to generate some kind of news, either tariffing or job cutting, and just stopping that and just managing. I don't know when we get there or if we get there, and I think that's the biggest risk I have.
Is the market too expensive now?
Well, it isn't if we get these 13.6%, quarter-on-quarter growth years. It isn't. But it is if we don't. And so it's just, there's always bull bear cases, Terry. And, if we're, to my mind, we're going to see that play out for at least 6 months more of consolidation before we answer that question.
You made a point of writing this in your monthly market strategy piece. A legacy from excessive money printing drives stock prices over projections for EPS growth. Why is that important to note?
Because, we look, I just quoted it myself, the 5-year average at 19.8 or the 10-year average at 18.3. And that's historically well above, 15 or 16 PE you might have seen before all this money printing. So I've seen over the last, 15 years, there's about a 15% valuation lift that just comes from the sheer amount of money printing and money floating around out there. And frankly, Bitcoin is part of that, Terry. Terry, it's like a reservoir of excess money that's trying its way into Bitcoin.
Yeah, it's interesting. NVIDIA reported their earnings late yesterday. Today's the 27th of February, so it was after the close of the market on the 26th. And investors had been concerned leading up to that report that the report might be bringing in volatility back to the market, in addition to what the tariff news is already bringing. You think that's likely?
Well, Terry, I'm looking at a stock that's down to $3.50 a share, minus 2.7% after earnings this morning. It has been down for a good, since the 20th of February. That's now the last week or so. So it does seem that NVIDIA is kind of the leading edge of this new appraisal of the uncertainty, because it really can affect them in terms of having the data center investment that's driving that stock up, get pushed further and further out. And that is something that might be causing a lot of profit taking we're seeing on NVIDIA these days.
What are you looking for the stock market's annual return to be this year, or is it still too early to say?
Well, Terry, like I said, we're going to get consolidation. We've had 3 months of it, and I expect a few months more. And then I think, we might get a rally late in the year. It might give us 8 or 10%, which is the standard return. That's what I would pencil in right now. I wouldn't pencil in a very strong year like we've had the last 2 years. It's just the valuations to me are a little too rich.
Strong buy stocks you're looking at include CrowdStrike, Citigroup, and Amphenol.
Yeah, CrowdStrike, ticker CRWD. I've got a number 2 rank. I've also got a $395 share price target, which is incredibly high, Terry. It's a 90.5 PE, just crazy high. So what's going on here? It's in the security space. Cybersecurity is crazy important, and this thing has been driving up for years now. But I do think, again, this is the valuation scenario. Is to say all the good news is priced in with CrowdStrike, I got to say, yes, it is.
And Citigroup.
Citigroup, amazing run here, Terry. Back in October 2024 or 2023, when the Fed started cutting rates or talking about it, I think it was at $35 a share. We're now at $80 a share. So it's just an incredible run on Citibank shares. Price earnings ratio at 10.5 still, Terry. Not that's respectable. And the Zacks ranks number 1. So hard not to like this stock as a trading vehicle. But again, I think after a 1.5 year run, it's more likely than not to also consolidate and go sideways for a while.
And Amphenol.
Amphenol, ticker APH. I like this. It is a large cap trader holding, and it's in electronic connectors for fiber optics, interconnect systems, antenna sensors, things like that. And the chart is just really excellent here. And you've got a $66 a share price and a target price we have, Terry, $75. So it's actually number 1 rank with a gross score of B and a nice $10 lift to the target price. Kind of like all that.
Our chief equity strategist and economist, John Blank, on solid stock market returns. With John, I'm Terry Ruffalo. Zac's 7 best stocks for the next 30-day special report is available for downloading. And this just recently released report names 7 tickers, and they can be downloaded for only $1. More details are available at zacks.com/promo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.